Hey everybody, welcome to Trend Rebel. I am going to be making a video today on options trading, and there will be some people that may jump in and out as we go and to go through this, but I wanted to compile something at least recorded so that everybody can kind of see what we're doing. We have a lot of new people to options. So first question to answer, and again, this is Banana, is what is an option? Well, an option is the right to purchase 100 shares of the underlying um, stock. So if you buy one option, that one option is actually leveraged by the ability to buy 100 shares underneath it. And then if you buy a call, you're buying an option to buy 100 shares. If you're buying a put, you're buying an option to sell 100 shares at those strike prices. So the very nature of the fact that you're buying something that's supported by 100 shares underneath it is leverage in itself. So that is the leverage part of this. The second thing I wanted to say, and it's super important that you all understand this, especially if you're newer, is that options will wreck you. Options are a very, very simple looking, easy looking device to utilize, instrument to utilize. However, they are designed to destroy people who are just looking to trade them. The creation of the option was solely for protecting positions, shorts or long positions, by hedging. So the option was created to hedge. And a few years after it was created, people started utilizing them as a tool to invest in. The part that most people don't understand is that pricing is made by market makers. It is not all supply and demand. It is more pricing pushed by the market makers. So you can get very easily trapped in situations with options. And don't misunderstand me. When options are priced, sometimes you'll see the same situation. You'll see differences in prices between their strikes and where they go. And so you have to know that options are manipulated by the market makers. They're created for them to make profit. The people who make the most money in options are the people selling them. And if you are a retail trader, then you probably have very little capital compared to a market maker, so therefore your ability to sell options is very limited. A lot of retail traders do sell options, however you have to have minimal account sizes and all sorts of caveats to run through to do them. But once you bring your count up to a couple 100,000 or a couple million, then you can start getting into the selling option game, and I will create a class for that as well, because we do have some people getting up in that range too. So first thing I want to start with after all of that kind of preamble is to show you what options look like on a ladder here. So this is my Webull account. And again, if you're using a different account, things are going to look different. Robinhood's account for trading options, their options, they look okay. So it's doable there. Their charting doesn't. So we prefer people to move over to Webull. Interactive Brokers has a lot more strategies and a lot more depth to option trading that you can utilize, but again, it can be complicated. This is the platform that I think is easiest for everybody to use, and this is the layout I've created for this platform in order to execute on it. The training that I'm going to be giving to you today is going to be for single leg options only, and you'll see that in this box right here. There are lots of different types of option strategies. The single leg option is the easiest strategy. It is you're buying something that's going in one direction, and you buy it and you sell it, and that's it. So we will go into, again, classes about other option strategies in the future. So I picked SPY. Here it is. It's trading at 560. As soon as I touch it there, you'll notice that my chart pops up. I can see a chart of SPY rolling along here and see what's happening there. The options pool floats up here, so we can see everything that's happened. In the middle here, these are called strike prices. So you'll see that the top of the column is called strike. And then if you scroll up, you can see that we have different numbers here on the strikes. So these numbers, okay, 0, 3-day, 4-day, 5-day, this is the time frame of the expiration of the option. So a 0-day, or ODTE, you will see 0 DTE, is a option that's expiring on the same day. So these options are all that you see here. This side is calls, this side is puts. They're all expiring calls, puts. They're all expiring today. So this instrument is moving very quickly. You can go to a 3-day after today, because today is Friday, so there are no options for Saturday. There are no options for Sunday. Monday is the next available time frame you can buy options in, and you can see these are the options for Monday. Prices will change drastically between days. A 0-day, you'll see a lot lower prices with strikes. Again, these are the strikes. Strike is the actual price of the stock. So currently, the current actual strike is 560.32, or as this changes. You can buy options with strikes of 560, 561, 559, etc. So again, I just want to make sure I got you on the time frames. So 0-day options expire today. Three-day options will expire on Monday, etc. So a Monday option will no longer be a 3-day option on Monday. On Monday, it will be a 0-day option. And I hope that's clear. All right. Next area we're going to talk about is calls and puts. So I already described to you that a call is buying the right to purchase 100 shares outright, and a put is the right to sell 100 shares outright. So because of that leverage, you're able to buy these options at much discounted prices than it would be if you're purchasing the full 100 shares or selling the full 100 shares or shorting. So that's what makes this attractive. Very little money to get a very big gain. However, they're dangerous. And again, I think I told you you'll wreck your account. 95% of people who start trading options, they blow at least one account to zero learning. And I really don't want you guys to do that. So the best thing to do to start playing with options is to use them as a hedging tool. So in other words, if you follow Trend Rebel and you're going through all of the swing trading that we're trying to teach you guys, a great strategy for swing trading is to hedge the downside so that you can make money on both sides of it. You can make money if your swing is failing or not working properly. You can make money with your hedge, which you would hedge with an option or a put or a call, depending on which way your swing trade's going. Or you make money on the swing trade on it is. So the idea of a hedge is that you never want your hedge to be making money because you want your swing trade to be making the money. However, options give the ability to make money in case things go wrong. All right. So this account is a dummy account I set up. I threw a couple dollars in it so we can trade actual options in it. So you're going to see the execution on Webull as well. And after that, I will show you how to set up a Webull account to look just like this too. All right. So we talked about calls. So calls are on this side. Now we talked about strikes, but I didn't tell you about specifically what they are. So a 560 strike, so this is 560.60, is called at the money, or ATM. So this particular strike price, 560 right here, is at the money. 561 is out of the money. So in other words, we haven't gotten there. So all the strike prices above this, 61, 62, 63, 64, etc., these are all out of the money. And it's important to know those designations, and I'll explain why in a second. Below 560 is 559, 876, all the way down to 0. Those are in the money. So you have three designations for strike prices: in the money, at the money, and out of the money. And again, out of the money, we haven't got there yet. At the money, that's where we are. In the money, we've already passed that price. Okay. The way options are priced, so just so that you can get an understanding, is the in the money, meaning in the money prices are going to be higher than out of the money prices. And the reason for that is that if you bought 100 shares at a strike price, 100 shares of SPY at a strike price of 558, you're already making money. And because the current price is 560. So how can I sell you shares at $558 when the price of the stock is already 560? The way I can do that is I can charge you in the option a premium in order to do that. Now, these prices and options, one thing you do need to understand is that option prices are in the hundredths. So in other words, anything you see on an option price, you add 2 zeros to it because that's how you're paying. So one option here at 558 is $278. Okay, it's $2.80 or 78 cents per share. Because you have 100 shares, you have to buy you have to pay the premium total, which is 278. Okay, so it's not a $2.78 to buy this option. It's $278 to buy this option, just so you understand. But you're represented by 100 shares. So at the premium difference between 558 and our current price 560 is 278 minus, okay, the spread, and the spread would be the difference between 560, 67, and 558. So minus that gives you the price, the actual price for the gain, plus you're paying for a premium to buy at that level. And that's what adds up to the option price. So that's how they price it. So there's a variable number there, that's the premium that they calculate, that the market makers calculate, and there's a real number that you can calculate simply by subtracting the strike price from the current price. Okay, so what that would be is 560, let's say it's 560 even, minus 558 would be $2 a share. So the $2.86 here is represented $2 by the difference in price and 86 cents for the premium. I hope that makes sense because it is a difficult concept to grasp at first. But maybe if you watch the section over once or twice or ask me questions, I'll be happy to explain it even more. And you go up the other way and you have the same difference here. You have it out of the money is 564 we're going to choose, and it's 560. So the difference between that is $4, but and plus premium. But you'll notice the strike here is only 4 cents. And 4 cents, if we were going to buy one, it would actually be $4. Remember, times 100. So $4. So why isn't that we taking this, subtracting that? Because that's not how it works. Right now, these are out of the money, so they are worthless. So the only thing you're calculating here on out of the monies is the actual premium. So you calculate the premium for the out of the monies. At the money is a hybrid. It's the difference between where we're at price-wise and the actual strike, which is 560. So there's a 76-cent difference. So that 76 cents goes into this $1.23 plus the premium that the market maker charges. That's for calls. Now we go to puts. It's the exact same thing but flipped. So you'll see that this is grayed out. This grayed out area here that I'm showing you, those are all starting at the money, in the monies below it. And then if we go and like a diagonal, the puts, they're flipped. These are all in the money all the way up until we're at the money here. So looking at a put, you have the same scenario. Price is 560, 563 is a strike for a put. So you're making the $3, or I should say $2.25 at a 563 strike. You're making $2.25, so that's $2.25 plus premium, and that's how you get the price of this option here. So puts, you're selling 100 shares. In other words, you're selling somebody else's shares, so you're going to gain whatever the strike is here minus what the actual price is, and plus the premium. And then these are going to be, so that was a in the money, and this is at the money, and these are the out of the money. So for a put, if you bought a 557 strike for a put, you're out of the money by $3.30. So $3.30 because it was at 70. At $3.30 out of the money, which makes it cheaper because it's much harder for SPY to get to 557 than it is to get to 559. So the reason that these are cheaper is that it's less likely that SPY is going to get to that price. Now, how do you make an option millionaire? You have somebody who gambles all their money into a strike that's far out of the money, okay, on a put or a call. This one's 4 cents, this one's 10 cents. Either one of those, they buy a shit ton of options in those ranges that have very low probability of actually hitting, and they hit. And that's how they get these option millions. Now you're like, oh, well, that doesn't seem too hard. Well, it is. It's very hard. And these are 0-day options too, so these move very quickly. And you need to understand what happens with with these options as well. So there's one part of the option that also dissipates over time. There's a part of the premium goes away as you get closer and closer to the expiration. So again, we're looking at a 0-day option. So the expiration of this option is today. So at the end of the day, all of these options are worth $0.00 because they all expire. So your goal is to buy your option and sell it at a premium that's higher. But what you are fighting is not just the price action of the stock, you are fighting something called theta. Okay, now theta is your worst enemy. Theta on a 0-day option, and again, I'm using 0-day right now because it's the most extreme of the options. It should give you a real flavor for it. So theta, it basically eats away at the premium or the value of the option over time. And on a 0-day, it goes very, very quickly. For instance, this option here at 559, if SPY stays at 560 and it doesn't move at all, 560.72, and it doesn't move at all, at 359, this will not be 26 cents. This will be zero. Okay, it will go to zero because there's no time left for this to change from 560, 60, 70 or whatever to 559. There's no time left, so this is zero. So you need to be aware of theta because it changes the price of your option over time, and it does it very quickly. And the closer you are to the expiration of the option, the more effect you will feel. Now, I'm going to say this a couple of times in this video, but what I want you to really draw back from this is the buying options close to expiration is a risky, risky trade. It always will be. It is intended to be. If you're swing trading or you're trading um, um, or you're trading out, buying out in buying longs, etc., and you want to add options to your portfolio, and you think something's going to happen, the safest thing you could always do if you integrate options into your plan is to buy time. So if I wanted to buy something, an option that I thought was going to have, let's say I thought the Fed was going to make an announcement today, Friday, or let's say I think it was going to make an announcement on Monday. So I want to buy an option because I think that SPY is going to go through the roof on Monday, which is right here. So this is Monday, it's 3 days away. I think it's going to go through the roof, and I want to buy an option, a call, to capitalize on that. I could buy in the money, at the money, or out of the money. Let's say I don't have a lot of money, so in the monies, while safer, okay, in the monies are safer because they move slower, okay, and you have more premium there, you're more likely to get something back out. Whereas out of the monies are, if it doesn't move, you're guaranteed to lose everything. But if I bought one here, I wouldn't want to buy it on the date that I thought something was going to happen. The reason is that I am pressured on that date for it to happen. And the other reason is that I will always be wrong. Okay, I will think the Fed is moving left and they will move right, and the market won't move right. It'll move down the center and then go left. So you just never know exactly when things are going to happen. Now at Trend Rebel, we show you pivots and we show you how things move. So we always give you a target. So you can bounce off one target, you know you're heading towards the next. And then you're going to bounce off that target, you have two options. You're going up or down. And we give you both those scenarios so you can choose from. When you're playing options, you want to buy yourself time so that when the price is approaching those pivots, you don't have to worry about it. So again, I wouldn't buy a Monday expiry. I would buy myself time. So if Monday doesn't do what I want it to do, but I know it's going to do that, I know it's going to go up, maybe I should buy for next Friday next week. So that's what I would do. I would come to next Friday. But then you start looking at the premiums, and all of a sudden, wait a minute, 7 days, if I want to buy a 561 call 7 days out, that's 293. Hold on a second. I was just looking to buy one for Monday. It's only 131. That's the real rub. It's more expensive to buy further out. However, you will be much safer. You will have a better chance of uh, hitting your target or having something happen in case there's a delay, and you'll have a better chance of not losing your money. Also gives you time to react for maintenance, etc. And I'll go into that in a little bit. but you will be protected from theta that way. So you will have less decay of your option premium by buying that far out. So I strongly recommend you do that. And if you can't afford to buy the right option, don't buy the option. 99% of traders who are retail traders who are trying to figure out options buy what they can afford simply because they can afford it. For instance, if I want to buy that 561 option 7 days out, and I go here and I say, this is the one I want. I want 561 because I am predicting that the Monday before this, that SPY is going to go to a pivot point of 565. So I'm going to buy this one. Even though it's out of the money, I think I'm covered because I'm 4 strikes out of my goal and I'm 7 days away from my target. So I think this is a pretty safe one to buy. But I don't have $300 for an option. So how am I going to buy $3 for an option when I get there? Well, I got $150 and this is my target is 565. So why don't I just buy my option here? Well, you'd be making a mistake. You'd be letting your account size determine your option purchasing. And that is the biggest mistake you can make. Don't allow the money in your account to decide what you buy because you're going to buy it wrong and you're not going to get there. The difference is that what you really need to understand is that if you can't afford to buy the right option for that instrument, and for this case SPY, find a different instrument. Go look at NVIDIA. Now that they've had the 10-for-1 split, the option prices are down. Go look at something else. Anything else, find a different instrument and find a different way to play it with options. Buy the right material. So the right material is always going to be figuring out where your goal is for the stock. Okay, and so for this example we're talking about, we're looking at 565, SPY to hit 565 by Monday. Okay, so that's my goal is I want 565 by Monday. And in order for 565 by Monday for me to profit on that safely, I want to buy an option. And my recommendation, and again, this is not financial advice, blah, 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 disclosure, go check the Discord for all disclosures. So if I want to buy the right option, what I look at is I look at my strike and I try to stay within 2 strikes of the current strike. So current strike is 560. So I could be out of the money too, or I could be in the money too. Okay, right in here. That's the sweet spot that all the data says is right in here. All right. Now let's talk about those 4 positions though. So we've got basically 5. So we got 1, 2 we got in the money, at the money, out of the money, out of the money. All right. If you're following the picture, I'm going to do that again. So 558 is in the money. 559 is in the money. 560 is at the money. 561 is out of the money. 562 is out of the money. So those are the 5 positions I want you to look at. The theory is, and what you should understand is that most of the time, movements don't happen in big swings. Like seeing 570 in this range is an anomaly, okay? Or seeing 540 would be an anomaly. So we want to stay in a range where we'll be safe because we can make tons of money and be safe. Now I'm going to show you these 5 options in risk class. So 558 is your safest. 559 is your next safest. 560 is your safest after that, third safest, fourth and fifth. So the least safe option to buy is the one that's furthest away from the strike price. So 234 is a 562 strike. So that 562 is 2 points away from the 560 strike. So that'd be the least safe one in the parameters that I'm giving you. I truly believe that these are the option ranges that you should be looking at. So you start it at the money, you look 2 below or 2 above, and that's where you should be. Calls and puts the same. Everything I'm teaching you here for calls will apply to puts. I will show you puts separately, but I'm not going to go into all the detail because they're the exact same thing, just flipped upside down. Okay, so that's where I want to buy my position and to be safest. Now, what I need to also do is when I'm going to buy my options, I need to make sure to buy with a stop loss and potentially buy with potentially to also buy with a take profit if you want one. So what we're going to do is to make sure that we can do that, and I'm going to show you that in a second too. Let me just check my notes here. So we just discussed good versus bad premiums, how to buy. We talked about time. So we talked about buying extra time. If you are buying I want to just go over time one more second here. If you're buying a swing trade and you're playing the 4 hour and your swing trade you think is going to last about a month, okay, that doesn't mean you have to buy a hedge that's a month either. You can buy a short-term hedge like a week out, once a week, every week, okay, in order to hedge your position. So you can spend a lot less money buying a weekly hedge. Let's say if you bought 100 shares of something, you could hedge it with one option or 10 options, 10 puts. And you would do that, you want to spend like about 10% of what you spent on your main position on a hedge. And you can take profit on your hedge at any point in time. And there are videos that we have in here for that, so I don't want to get too far off track. What I did want to say is that your option purchasing to hedge any swing trades does not need to be the same time frame. Okay, you do not. If you have a plan for a swing trade that's a month out, you do not need to buy options 2 months out. Okay, for time. You can buy shorter positions with those options and buy just make sure you have one in place. That's all. So if you buy a weekly on expiry, buy another weekly, etc., so that you're always covered. That's the point with the options there. So you can definitely use cheaper ones to cover you in that respect. But if you're just straight playing options, which is what this call is about, then you want to make sure you give yourself time. And I know I've said it a bunch of times, but it's a number two failing reason is that buying the wrong thing because your account size doesn't allow you to is the number one. Buying the wrong amount of time is the number two. Number three is thinking that you can average down with options. Now, I'm an expert option trader and I can average down with options. I can also blow my account. I'm fully capable of doing that, even with all my experience. I have no problem blowing an account with options when you're getting cocky and things are going crazy. So what you really want to do is play it safe and follow the rules. And those rules should include a stop loss and potentially a take profit too, because it's a good thing to do. And we're going to get that in a second. I just want to just cover my notes. So uh, we talked about premiums. Now we talked about time. I beat it into your heads about time. Long-term options and maintenance. We just talked about kind of how that works. Averaging down. I just told you that. Oh, one other thing I want to talk to you is about liquidity. So very important. Liquidity is this number here, this volume. So this is open interest volume here on these options. So for instance, 560 has 13,155 is the open option, is the volume. If you have zero volume, that doesn't mean you have zero price and you can't buy it. There's always a market maker available to sell you something. I'm going to show you an example of that. So let's go to Riot, which is one of my favorite stocks that will never perform. So we're going to go to Riot. I thought I put it in there. Did I just put it in there? Do I have it in here? Yes. Okay. Here's Riot. So let's go to Riot and let's just look out in the distance here so I can give you a real-time example of this. All right, so here's Riot. We're 49 days out, which isn't relevant to this conversation. What is the volume. If you look at the volume, you got 15, 5, 0, 0. Okay, I can click on this option right here for $1.75 with a $9 strike, which is a great position to be 49 days from now. It's $175. Okay, I'll click on that to see buy. And look, it shows me that that I can purchase it. I'm able to buy it, even though there's zero interest in here. That's because the market maker is willing to sell it to me no matter what. They'll sell it to me. The problem you're going to have is what if you want to sell it back? They don't have to buy it. Okay, so if you don't have any volume here, then your sell may not be able to hit the numbers that you're thinking. So the spread here, the buy, the bid, and the ask, which I'm going to go over in a second, is a spread of 14 cents or $14. But if you do a market sale, you may not get 160 because there's actually nobody there to buy it. So you may actually get zero. So make sure whatever stock you're trading off of or whatever stock you're looking at, make sure that you have open interest or volume in that stock. Otherwise, you're potentially harming yourself by putting yourself into a position where you cannot unload it without a massive loss. I'm trying to get rid of this position here, so let me see here. I don't want to trace this. I want to get rid of it, and usually I right-click on it, and I can do that. I don't know why it's not letting me. Okay, whatever. It's fine. So now I want to go back to SPY so that we have something that you guys are all used to looking at, and go from there. The um, the strike prices that are here have a bid and an ask. So you'll see, Craig, thanks for joining. Just FYI, nobody showed up, so I'm recording on a separate screen while I'm talking. My apologies, but I can't shift it over right now. But I'm happy to do that. I'm going to shift it over afterwards for setup if you want to join in then, and feel free to talk or whatever. So
Not a problem. I wasn't sure when it started, so I wasn't sure if this was it or not, but
this
thanks for
is,
clarifying
but
that.
nobody,
So I'm
yeah,
just gonna,
nobody was here for the first 20 minutes or so. So I just went ahead to start recording it in a bigger way, so the video will be much better. So you're probably better off just you're welcome to listen, but I can't. You're not going to be seeing what I'm talking about at the same time. So I apologize. Um,
roger that. I'll
uh,
just catch it from the start later on the recording.
Makes sense. Perfect. And then open a ticket if you want to talk to me about specifics, because I'm happy to help you there too. Okay.
Sounds great.
All right,
Thank you.
thanks. Yep. So the what I want to explain now is about bid and ask. This is the difference. So the bid is what somebody is willing to pay for the option, and the ask is what somebody's willing to sell. And the difference between the bid and the ask is called the spread. And you'll see the spreads here are very tight. So they're 1 penny, which is really $1, right? Because times 100. They're 1 penny apart. So that's good. Whenever the spreads are tight, that means you have a healthy market. So we have a lot of volume, spreads are tight, we know that we're going to have an easy way to get in and out of these. So we don't have to worry about volume or market sales or market pushes. Most people will sell with a limit. I tend to just browse over the bids and asks and the volume. If they're good, I will do a market sale and not a limit order because I always do things manually. Um, and then, just trying to figure out why that won't open up. Okay, whatever. And then we can go into the next part of this process here. So I've explained liquidity, we explained the bid and the ask. And again, bid is what people are willing to pay, ask is what people are willing to sell. And you want to buy right in there. You want to buy, you always buy at the ask because you know your order will get filled. If you want to buy it, plan ahead and buy it at a different price as it's going to get there, you can do that as well. But I'm always, when I make a decision, I'm usually in, so I just buy at the ask. Now, I think what we should do is let's go and actually execute on purchasing an option so I can show you guys kind of how this works. And we'll do a buy of a call and we'll do a put and we'll sell them. So I've created a couple of different things here for you guys to look at. This will be the way we purchase things, execute on it. I don't know why this isn't lighting up. Um, not available. Um, but I created in TurboTrader, which is what I use all the time. I created simple purchases. So this is buying one at the ask, one option, buying 5 at the ask, buying 10 at the ask, buying 20 at the ask. And then we have, uh, so this is just buying. This is only buy, and they're quick buttons. So if you hit here, here we go, sorry. So if you click on here, let me see if I can get rid of this again. I don't know why it's doing that. Okay, get rid of it. If you click on the volume area here, these will light up. You can utilize these to buy one. So I can buy one at ask, and that's it. I'm going to purchase one, and I want you to watch the order flow here. So I click over here to buy it. The ask is $2 or 2 cents. I'm going to click that. That is going to that has changed now. I'm looking once I clicked on this, my chart changed to the option chart. So I'm looking at that live option chart. When I click on the buy, it's going to stick it in the working here very quickly, and then once it's filled, it's going to put it in here. So that will happen in a split second. So here we go. I'm going to buy one at ask. So boom, you saw it flip through the orders, and then you'll see it right here in the bottom. There it is. So there's my option. It's purchased at 2 cents, which is really $2. So you can see my market value right now is $2 because that was the purchase I had just made. I also have 2 position holders set up. I have one for calls and one for puts, so I can see the difference between them as I'm flipping through things. And my open P&L shows I am down 50% on the purchase. Now, why is that? Because I bought it for 2 on the ask, and the bid is 1. So it's already, when in purchasing it, I've already lost that because we know that they use the spread here to calculate, plus calculate. So even though it says the market value is 2, I'm actually down 50 cents in there, which is fine. and that's the way that works. Now, if I'm watching things and let's say I'm going, watching SPY and I say, oh, SPY's crashing now. It's not going up like I thought it was going to do. How do I get out of this position? Okay, you can either put a limit order to set it to where you want it to get out from, which would be hitting this close button. The order entry pops up down here. You can set the limit for what you want to sell it for, and you can place the order. Or my preference, because I typically sell as I'm going, is I'll close it at market. So as long as I click in some space here to that I'm working on that one, I have it here. It's lit up. I can hit close, and that one button there just eradicated it. So you'll see that it went through here very quickly. You didn't see it happen, but down here in my orders, it shows that I sold it at a penny or a dollar. So my total loss for the day was a dollar on this particular trade, which was fine, and that's was the whole point of me showing you what this is. I'm trying to get. I'm really getting upset that I can't delete these things when they pop up because that's something I normally do. Anyway, all right. With that. Now let's go and let's buy a put. So we think SPY is going to fall for the rest of the day. Again, we're paying high risk, zero DTE options, and for examples, I'm just throwing away pennies here for you guys. So don't look at these strikes. They're not the strikes that you would use. I just want to show you examples of how they work. So we're going to buy a put. Okay, so a put is the ability to sell 100 shares of something at a certain strike. So I want to pay $5 to sell a 100 shares at 556. And I'm betting that if SPY goes down further, that somebody be willing to pay more than $5 for the right to sell 100 shares. And that $5, if SPY dropped one, two, three, $4 in price, that $5 could be go up to $76. So you can see there's massive gains there. And obviously buying one option is different than buying 100 options like you normally do. But again, these are examples I'm showing you for a specific reason. So we've got this highlighted. The chart is now on that one. I'm going to buy one at the ask. You saw it flip through the order flow, and now it showed up in my put column. So I have a put here that I'm working on. I'm already down $1.50. Hopefully SPY goes down while we're talking about this, and I can get my money back. Now I want to show you Turbo Trader, another function I set up. So this is how I do things because I kind of do them manually. However, now this is what you should be doing at a minimum, which is having a stop loss built into your order. So with Turbo Trader, I went in, I set my settings up. I'm going to show you the settings. Oh, I see what's happening here. It's showing on a different tab. That's so odd. Okay, I'll show you how to set them up after. But basically, if you hover over it, it'll tell you. It says the limit price is at ask, so I'm buying basically what people are willing to sell it to me for. My stop loss is set at 20%, and I'm buying one, and it's for the day. So I am now going to buy a call in reverse of what we just did up here again. I want to buy one at the ask with a stop loss of 20. So I'm going to put that in place. You're going to see the order happen, and then you're going to see it show up back down here. You'll also see an order standing here for the sell at the 20%. So let's go ahead and purchase that. So go ahead and do that. It should be lower than 2 cents, and I see. It's hard to buy with a stop loss at this level. Hold on. I think I can do I think I can do this one. So we'll do a $9 one. Okay, that executed. So I just bought a 563 strike for $9, okay, and with a 20% stop loss attached to it. So here's my option, my call that I just bought. You'll see it's down $1.50. You'll see that purchase is over here. It's been filled, and that the stop loss, which is the selling it at a 20% loss, is at 0.07, and that's working. And that'll say it's working until it's filled. If you go down here, again, you'll see that there's the order filled. There's a sell order that hasn't been filled yet. So that call is in play. And then we have our put from before, which is also in play. Now I want to show you one other. And if I want to sell any of those, I can do this. I can cancel, okay, anything that's in here that's working, I can cancel it. So I'm going to go ahead and hit this. And what that's done now is canceled all my orders. So I just got rid of my stop loss. Okay, maybe I'm watching it and I'm like, I don't need the stop loss. I know what's going to happen here. So I just got rid of it by just clicking that cancel all single options. It cancels it. It does not sell my shares though, my options at all. So just trying to explain what that is. If I wanted to close it, either one of these, I would go to, you'll notice that you have a position. So position one for each thing that you own. So you can see these two here. If I wanted to close them, I'd have to click on one of them and then I can hit close. I click on one of them and hit close. So if I want to close these two out, so let's go ahead and just do that right now. I'm going to close this one out here. Boom. That's done. It's gone. Position's gone. My put is gone. And now I'm back up to my call I still have. So I'm thinking maybe I should get rid of my call now because that's bumping up a little bit too. So let me see. I'm going to close that position here. I've hit this position one. I hit the little volume area there. When you hit the add, when you hit in these two columns, it opens up an order entry. So you don't really want to hit in the ask or the bid. So you hit in a different area, which is why I like to keep volume. It does two things. It tells me how much open interest there is, and it gives me a space to click on where space is very limited the way I have my setup. But then I go over here. Once I hit close, you'll see it pop up here, and then you'll see it close out down here. So I'm going to show you that right now. Say bye-bye to the call. All right, and it flipped through there so fast that it didn't even go here, and then it positioned itself down here. That is buying with a stop loss, an automatically attached one. Now we have another setting, which I set, which I highly recommend this one for you guys as new people too. And you can set these to different things, but this is buying one at the ask with a stop loss set at 20% loss and a take profit set at 20% profit. Okay? So in this instance, we are saying that we're playing both the bottom and the top. We know how much money we can lose and we know how much money we can make. And we want to automate the system so the system does it for us and we don't have to think because the more we think, the more we drink, the more we drink, the better we do. The better we do, the more we lose because we didn't do as good as we thought. So going back into here, we're going to figure out what to do next. And we're going to buy a call that's out of the money, big time out of the money because I'm just blowing money here for you guys to show you. We're going to buy a call that's out of the money and with a stop loss and a take profit. So you're going to see when I click on this buy, it's going to populate the working area here. You'll see it in place. It will keep two orders this time. It'll keep a stop loss sale and it'll say a top take profit sale. And it will also show the purchase in here. So we're going to go ahead and good to go. So actually let me just look at SPY real quick. All right, maybe we could make $1 on this while we do it. So let's actually buy something a little closer. So here, we're in the range that I like to buy in, right? We're probably not going to hold it long enough for that, but we'll just do it. And this is 0 DTE, so super risky, but let's get it done. All right, we're buying one with a take profit and a stop loss. So that's executed. We are in there. Our call has been purchased. You can see that right there. It says filled. We have a stop loss in place at 8 cents. That will blow it out, and we have a take profit at 12 cents, which will go out if the value of the option goes up to 12 cents. You can cancel either the stop loss here or the take profit. Either one of those you can cancel independently. You can, on the fly, if you're doing something else, come in here and hit cancel all single options, which will cancel both of these and any other option orders that are going. Or you can hit close on this, and it'll just close the position, which will also cancel these. So the nice feature about using these buttons here on the Turbo Trader is it gives you the ability to get rid of everything in a couple of buttons if you know what they are. So if you want to grab the wheel and take control yourself, you can go ahead and cancel all the single options. So I'm going to do that right now. I'm going to get rid of my take profit and get rid of my SPY's climbing a little bit. Enough to, yeah, maybe we can see if the take profit works. So look at that. We're almost at the take profit here on this. This is a great thing. We're up 20%. Oh, and it automatically sold my position because I was in the money at 20% and out the door it went. And that's the example. So I hope that this has been a good explanation. It kind of covered everything on there. That's going to be all I do for training, for beginning training of options. My next segment is going to be how to set up Webull, which I will do for people. It's really important to set up your turbo traders the way you want to, in your comfort level. Set up your ladder the way you want to. This is called a ladder. Get all your stuff in line here that you're going to use. Try not to trade. If you're trading options, your eyes have to be on them. And try not to trade more than 2 or 3 positions, 2 or 3 different companies stocks at one time. Doing more than that will give you a headache. It'll give you agita. You will be vomiting all over the place because it's too hard to manage them. The charts on here on this screen are only for what you're playing with here. You really should have TradingView open or something else open to run your charts, to look at your charts at the same time. I do highly recommend having multiple screens if you have the ability to do so. And trading options on your phone is tough to do unless you're trend rebel and you want to make millions of dollars. So thank you all for watching my option trading video, and I hope you guys get something from it. If not, open up a help ticket and I'll be happy to help you. Take care.